It's time now for a look at today's top business news with Brian Quinn, who joins me on set. Brian, you're starting with a look at how oil markets are reacting to the latest developments in the U.S. and the U.S. and Israel's war against Iran.
So, Jeannie, crude oil futures have actually subsided significantly, in part on news that Iran is allowing these non-hostile vessels to cross the Strait of Hormuz. Also on the news of Washington sending Tehran that 15-point peace plan. International benchmark Brent crude dropping back well below the $100 a barrel mark. It's currently trading just under $98 a barrel. That is still significantly higher than the roughly $72 a barrel it was trading at before the war, but it is far from the recent peak of around $120. U.S. benchmark WTI, meanwhile, easing back below $87 a barrel. None of that, though, means that the crisis is truly over. Analysts say that even if the Strait of Hormuz were to be completely reopened to tanker traffic tomorrow, it would still take weeks or even months for supplies to recover. Then there's the damage to production facilities across the Gulf region that could, in fact, take years to repair. Meanwhile, there are still plenty of signs that the Trump administration's assurances that the war will be winding down soon could just be wishful thinking. Countries are acting accordingly. Japan is especially dependent on imported oil. It has asked the International Energy Agency to coordinate yet another release of its members' strategic petroleum reserves. Here's IEA Chief Fatih Birol in Tokyo on Wednesday.
We still have a significant amount of oil in our stocks. 80% of our stocks are still with us. This 400 million barrels were only 20% of our stocks. If and when necessary, we are ready to move forward.
In the meantime, Brian, speculation has been swirling that some investors may have used inside information to actually make a killing on oil markets last week.
So Monday, we saw Donald Trump step back, at least temporarily, from his threat to escalate the war by attacking Iranian civilian power plants. That announcement quickly sent crude prices sharply downward. Just 15 minutes before the president's statement, a massive volume of oil contracts changed hands, and those who had bet on falling prices made a big profit. A similarly huge burst of trading in S&P 500 futures has led to widespread suspicion of insider trading. Delano D'Souza has the details.
It's an anomaly which stood out on global trading floors at the start of the week.
Someone sold oil at an excellent price a few minutes before the price dropped over 10%. So it's a great trade.
A transaction placed Monday when the energy markets were stable, 15 minutes before a Truth Social post from Donald Trump. It resulted in the price of oil plunging 14%, a windfall for whoever hedged their bets.
It raises some questions. Either someone has a great instinct and a lot of luck, which can happen, or it was someone who was tipped off. There aren't other possibilities.
Traders reportedly made bets worth around $500 million in the oil market before Trump's post. And for now, it's unclear if one or several entities were behind Monday's trades.
Perhaps some of these actions occurred from participants in the Middle East rather than within the administration. So I want to be super cautious about pointing fingers at anyone on that front, but it was highly suspicious.
While the White House says the administration doesn't tolerate any official illegally profiteering off of insider trading, some Democrats are raising alarm bells, calling the moves mind-blowing corruption. For now, there isn't any proof of market manipulation, but Monday's well-timed trades are similar to profitable bets made on prediction site Polymarket, which allows clients to place wagers on real-world events. Certain users anticipated the capture of Venezuela's President Nicolas Maduro or the killing of Iran's supreme leader, with some accounts created a few minutes before the incident unfolded. Hedging bets on Trump's decisions has now become profitable business for some.
Staying with the markets, Brian, give us a check on today's trading action.
Well, here in Europe, stock markets gaining some significant ground on those lower oil prices. Total Energies says that recent higher crude prices have made up for some 15% of production being offline. Its shares down 1/3% on falling crude prices, but the CAC 40 here in Paris still up 1.7%. Similar results from London and Frankfurt at midday. New survey data, though, is showing the Eurozone's economic activity for March at its lowest in 10 months, while France's National Statistics Agency has just lowered its growth outlook for the first half of the year to just barely above zero. Slowing growth combined with energy-driven inflation are raising new fears of 1970s-style stagflation. French Finance Minister Roland Lescure is warning of a systemic risk to the global economy.
This contraction in supplies has led to higher fuel and energy prices worldwide. This situation amounts to a new oil shock. And if this energy shock persists beyond a few weeks, the crisis could spread more widely through the economy and fundamentally take on a more systemic nature.
Finally, for business, Brian, the ongoing oil crisis is reinforcing many countries' resolve to continue the transition to renewable energies, but not all of them.
So China may be the world's top oil importer, but it has also made huge strides towards electrifying its energy grid, adding massive amounts of solar and wind energy in recent years. The U.S., under the Trump administration, though, is actually paying energy companies like Total to abandon green power projects and return to fossil fuels. Simon Moritz takes a closer look.
For some at the China Development Forum this week, the war in the Middle East has prompted calls for greater investment in renewable energies. Though Iran has signaled its willingness to let non-hostile ships through the Strait of Hormuz, the choke point through which 1/5 of the world's oil and liquefied gas passes, the shocks to crude supplies and markets since the start of the war have prompted a crisis not seen since the 1970s.
The current international landscape highlights that fossil fuels such as oil and gas often rely on imports and international transportation, whereas renewable energy sources like wind and solar are locally available and do not require such processes.
According to the International Renewable Energy Agency, more than 90% of green power projects were cheaper in 2024 than fossil fuel alternatives. Asia, where most of that oil was headed, is the hardest hit, but some countries are more prepared than others. China, the biggest importer of oil worldwide, has expanded renewables on a massive scale, thus making the country's economy less vulnerable to the price shocks.
China has made enormous strides in terms of new energy, renewables, green energy, and obviously that puts China in a very strong position with the AI revolution in access to cheaper sources of energy.
Pakistan is another country on track to save big after a long-term investment in green energy. After a large-scale solar installation, the country is set to save $6.3 billion in 2026 if current energy prices hold.
That wraps it up for Business Today. Brian Quinn, thank you so much.